welcome back to Primary Source China Investment. It's a new season, no new characters, and probably not a lot of plot changes. But Pengguo and I are here to talk about investment, trade, and policy. So this is show A7. And we had some press inquiries about why Chinese investors continue to want exposure overseas via QDII scheme. Well, we were taught in Econ 101 that the consumer is rational. And it's the case here that the investor has had a rough time on the intermediate term investing in China and RMB denominated asset classes. And let's get into the biggest ones, stocks. The CSI 300 is down 10% cumulative over the past 5 years, and that includes a year-to-date 2.5% decline. And, oh, well, you just can see the chart. You have a lot of volatility as well, right?
Yeah.
So you have a decline for 5 years and a lot of volatility. Number two, bond yields. 5 years ago, the yield on the 10-year was above 3%. Now it's 2.19. Now that may be stimulative theoretically to corporations and maybe people want to take mortgages, which we'll get to, but on a return basis, that's a huge step down. Three, real estate. Here's where it gets pretty ugly. The good news is that prices are back to 2016 levels, CPI adjusted. And the bad news is whatever you already owned is down upwards of 20%, depending on when you purchased. And it's down 6 to 8% in the past year in the biggest cities. You can see Beijing, Shanghai, Shenzhen here in this chart. Even the government's own mouthpiece is worried. From the People's Daily, consumer confidence is tricky. It changes slowly and has a lot to do with jobs. In a press conference this week, Liu Aihui, a spokesperson for the National Bureau of Statistics, came out and said unemployment jumped 0.4% or 40 basis points, so from 4.9 to 5.3%, and blamed that on what she called a seasonal rise or the graduating of college students. Well, the labor force of China is about 740 million people. It graduates about 10 million people a year. So if you just use her numbers, that means the unemployment rate for college students is 30%. So you can see this is what's causing a lot of the consumer behavior. We hear about tightening up, trading down, going for cheaper experiences even. If the consumer is not going to step up, and the investment thesis is always look for return, you'll have an immovable force caught between a hard place. Pengguo, what are your thoughts?
I think all those things really tie them together. So it's like the cycle. So they're all related to each other. If you see the negative things, then everything looks like negative.
Yeah,
But
that's true. Yeah.
yeah, and first thing is I think it's still back to the United States. The Federal Reserve, their interest cycle really have a big impact globally, and also have the much more impact in China than we thought. That's directly affect the exchange rate, and also real estate broke down, as well as a lot of the hidden problem, not resolved problem. They all get pop up during this recession period and trigger another downside cycle for a couple of years, especially in the past like the 1 or 2 years. China equity market is miserable, and the bond market still looks fine and looks good. So
Yeah, because bond prices going up, although yield going down.
yeah, and overall, unless you really get some bad individual corporate bond or some local government bond,
Right.
otherwise, if you just a treasury bond, overall it should be fine.
Yeah,
Looks
you
like
just hold to maturity, you're going to get your money back. Absolutely, yeah.
that's right, and also volatility, so we can say is much less.
On the fixed income side.
Yeah, that's right. As always, we need allocate some money into the fixed income side. But for the asset allocation, the most important thing is they try to allocate the asset not too early, but at least allocated to the recover area. That is makes some money. But for most of the people, they always allocate money to the peak period. We never asset the class to the peak. They allocate to it.
Yeah,
That's
I
the
am reading,
problem.
there are some investors allocating to China, China stocks. My opinion is they're doing it the wrong way, but um, trying to pick a bottom is notoriously difficult. You don't want to be first, catching falling knives, all of this kind of discussion, but
Yeah, and they
just
need to make sure the bottom is clearly
confirmed. Yeah. Yeah.
is go away, and then you can consider to allocate. And if you're just looking for the bottom, that is most of the people cannot do that, or maybe nobody knows how to do it in the world.
Right. And we've covered it a lot before. If you're looking for Chinese stocks, you've got to be very careful on what you're choosing, the overseas listed versus the A shares. And again, we've discussed a lot of large cap, very boring kind of financials in China that do perform really well. The backbone to the internet in China is also going to do very, very well. It's just not exciting. I mean, people are looking at, oh, Jindong is like such a value play. And we suggest to avoid those at all costs and keep focused on those large cap companies that look a lot like value at this point, right?
Yeah, I think most important is still in the sustainable sector. So at least, like even like the China bank industry is not like the fancy, but
Yeah.
relative defensive and stable than compared to other sectors. And if you want to play aggressive, try to find the sector firstly, and then you can figure out who's the good company to doing that. That is much more important, especially in current situation. The money is still people still have money in the China market. They are all
Correct.
sitting in the bank,
Yeah.
just looking for who's the next trend in the market.
Well, we're going to leave it there with the new season. It's the same message, but a new season. So we'll see you next week. Thanks.
Thank you.